Hims and Hers just borrowed $350 million, and the stock initially went down. But I went through exactly what the loan is, and I found some stuff that could be making current and new investors pretty rich. I'll break it all down in this video. Let's get into it. All right, so if you haven't heard, Hims just borrowed $350 million, and so I'm gonna go and tell you the secrets behind exactly what's going on behind this loan. It's actually pretty simple and amazing. If you can, give me a like and subscribe. I really appreciate it. So Hims and Hers is at $23.04. Keep this in mind. It's at $23. Currently, it is, May 20th? It's a Wednesday. They just proposed a $300 million convertible debt offering. The shares fell 4% after they proposed offering a $300 million aggregate principal amount convertible senior notes due 2032. Now, we can start going into the gibberish and all this, and it might start confusing some people. So what I did, it's probably most people, is I had AI simplify this thing for me. Now, this is the deal explained in plain English. Think of this deal as Hims taking out a special kind of loan from institutional investors. Hims borrowed $350 million with an option of 52 more from investors. The interest. Hims pays 0% interest on this loan. They do not have to make regular cash payments to the lenders. The convertible twist. Instead of just getting their money back in cash when the loan matures in 2032, the lenders have the option to swap or convert their debt into Hims stock. The catch for lenders. They can only swap the debt for the stock effectively if the Hims share price rises above $29.53. If the stock stays below that, they typically just get their cash back at the end. This is bullish. I'm going to go exactly why it's bullish, but if if the investor is thinking, oh yeah, we're not even going to, swap the debt until it's at least 29, and that's significantly higher than what it was. Like I said, keep in mind, it's $23 right now. That's already looking bullish. So the deal size, $350 million. Total cash that Hims receives. The conversion price is $29.53. This is the price the lenders will pay for the stock if they convert it, right? If they say, hey, instead of the debt, instead of getting cash, we want your stock. The premium right now is about $32, right? So like I said, I created this yesterday or 2 days ago. So the conversion price is 32% higher than the current price, which at that time was $22.30. The interest rate, 0%. I mean, I can't even, can you get a 0% for, until 2032? I know you can get the first 12 months of it 0%, right? But can we get until 2032? So Hims is paying no interest. And the maturity date is June 1st, 2032. So this is all good news so far. But why did Hims do this? Well, number one is expansion to pay for the acquisition of eucalyptus, which was over $1 billion. And then technology to invest heavily in their AI capabilities and fulfillment infrastructure. This is also big. This is really big. They have protection against dilution. Because you might be thinking, well, if those investors, right, they instead of the debt, they convert it into shares. Now there's a bunch of more shares, right? It's going to dilute all the shares. Well, Hims used some of the borrowed money to buy capped calls. This is a complex financial tool, but you can think of it as a dilution insurance for existing shareholders. The problem, if the stock price skyrockets and the lenders convert their notes into shares, it creates new shares, which dilutes the value of your shares, my shares, all of our shares. The fix, the cap calls offset this dilution. They effectively raise the price at which the dilution would actually hurt shareholders, up to $50 per share, almost double. It actually is, it is double the price right now, right? What this matters for you as an investor, and for me too, right? In the short term, the stock price initially took a hit, right, after the announcement. It's normal because investors often fear dilution or sell the stock to hedge the notes that they just bought. Long term, Hims got a massive pile of cash for free, 0%, to grow the business. If they use the money wisely to acquire eucalyptus, which they are, and improve their tech, and then the deal could be very positive for the company's future value. Because this is a 0% interest rate deal, the short-term impact on Hims' income statement is surprisingly small. It will not burden the company with heavy recurring interest expenses. However, it will affect the income statement over time through three main channels: issuance costs, diluted earnings per share, and future acquisition metrics. The interest expense, close to zero. The reality, usually when a company borrows $350 million, a large interest expense line item appears, which eats at the net income. But because the note features a 0% coupon rate, they do not record any regular cash interest expenses. Under the USG AAP rules, companies no longer have to split 0% convertible bonds to fake an interest expense, meaning the recorded interest expense for this debt will remain virtually zero. So far, no hit on the income statement. Non-operating expenses, a small upfront hit. So there will be a fee. They incurred a $11.5 million in transaction fees for this deal. So the impact, with the bulk of this deal being handled on the balance sheet, a small portion allocated to the equity component of the deal or general administrative fees may show up under the other non-operating expenses. Okay, a little bit there, right? And then, of course, again, we already kind of talked about the diluted earnings per share, which is the biggest factor. The basic EPS is unchanged because those shares don't exist yet. So basic shares count remain the same. The diluted EPS, this metric will calculate what would happen if all options and notes were converted to stock. So under the if converted accounting method, HIMSS must include the potential new shares in its diluted share count if the stock price rises. So the diluted EPS is going to look bad. The silver lining, because HIMSS purchased these cap calls at insurance, the dilutive pressure on diluted EPS is completely neutralized until the stock crosses $50.15. That's awesome. The downstream impact, revenue and operating income growth. The entire point of raising the capital is to deploy it. The cash will flow through the income statement sequentially over the next few quarters. Top line growth, they're going to have the acquisition of Eucalyptus, and the revenue will be added directly to HIMSS's total revenue line. Operating margin impact, HIMSS plans to spend heavily on AI scaling and physical fulfillment tech. This will increase their R&D, their SG&A, and their expenses line items, and impacting operating income in the near term to secure automated efficiencies down the line. So a little bit on that, but that's fine. You want a company that is investing into their future. So the bottom line, in the upcoming quarters, do not look for a massive interest expense hit on HIMSS income statement. Instead, look for higher overall operating costs as they integrate Eucalyptus and expand AI infrastructure, paired with a larger diluted share count balance in their supplemental EPS disclosures. Okay, that's fine. So, now that we got that all done, should you buy HIMSS stock? What exactly does this mean for the HIMSS shareholders, right? Okay, we know about they had that insurance for dilution and all that, but should you buy HIMSS stock? Well, right now, we're at $23. The convertible price from where it is May 20th, it's 28%. The cap call protection for all that dilution is 117%. So why would they do such a high capped call protection price? Is that a bullish sign for HIMSS? Let's kind of go through it. All right, so when the capped call price, in this case, which is $50, is set much higher than the current stock price, it usually signals three main things about the company's outlook, management confidence, and the cost of the deal. So number one, management expects massive growth. The signal is HIMSS management is explicitly stating that they believe the stock has potential to double, more than 125% increase before 2032. I mean, that's what, 5.5 years, 6 years, so whatever, but that's still okay. The logic, if the management thought the stock would top out at $30, they would not waste money buying insurance up to $50. They chose a high cap because they want to protect shareholders from dilution during a major long-term growth surge. Thank you. Because I do believe it's going to go over $50 for sure. A higher true dilution threshold. The baseline without the cap call, existing shareholders would start facing dilution the moment the stock crossed the conversion price of $29.53. But with the cap, it's set at $50.15. The cap call effectively neutralizes the dilution. So as an investor, you don't have to worry about your shares being watered down by the deal until the stock experiences a massive rally past that $50 mark. Understand though, HIMS can go past that $50 mark and then come back down and then go back up and go back. HIMS can do that. The company paid a higher upfront premium. The trade-off in the financial world, you don't get a higher insurance ceiling for free. Setting the cap way up to $50 means HIMS had to pay a higher upfront cost out of the $350 million that they raised. They willingly trade a chunk of cash today to ensure better protection for shareholders tomorrow. Again, thank you. I appreciate that. Bullish institutional sentiment. The counterparty, the investment banks selling these cap calls to HIMS are sophisticated mathematical machines. The takeaway, the banks agreed to this price structure because their data shows a realistic, calculable probability that HIMS can reach these heights, allowing them to price and hedge the risk effectively. So summary, a cap call price that's set significantly above the stock price is a strong, bullish structural design. It shows a management team confident in their 5 to 10 year growth runway and willing to pay a premium to protect their current investors from dilution. So thank you for watching. If you want my personal opinion, I am not a financial, advisor or anything like that, so I'm not telling you what to do. But I'm going to buy a little bit more HIMS possibly. I've already loaded up my position, but that's a bullish sign. As much as people think, oh, they're borrowing money and this and that, right? I mean, it feels like if they borrow money, that's, people don't like that. You fire people don't like, I don't know. But HIMS seems like it's on the right track. That this $350 million that they're borrowing not only is going to grow the business and the company, but they're protecting us as shareholders, right? All the way up to at least $50. Then, of course, it will get diluted a little bit, but if that's the cost to, have a growing, very high growth business, then I'll take it. So anyways, thank you for watching. Please give a like and subscribe. I really appreciate it if you are still watching. And yeah, I think a lot of investors had it a little confused about what that $350 million loan was. And so I want to say that I broke it down for you really easy and simple, but honestly, AI did it. AI is amazing, right? So, but I hope I was able to verbalize it enough for you to understand it and kind of present it in a nice way. So anyways, thank you for watching. Please give a like and subscribe, and never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.